The Aussie dollar has been falling for several months and is now trading close to 5-year lows. This is pushing up the relative price of imported goods in Australia, which puts upward pressure on inflation. So what does all this mean for our economy and the outlook for interest rates? Joining me now is Warren Hogan, Chief Economist at Economics. Warren, thanks for coming on the first show of the year.
Happy New Year.
Yeah, Happy New Year. Look, let's start with the dollar. Why has it fallen so much over the past few months?
Yeah, look, the currency is a great asset for our economy and in having it be able to move around and offset various economic circumstances. But in this example, I'm worried that it's moving because the RBA is being sort of pressured to cut rates, and our rates are not high by global standards. So I think there's this concern globally that something's amiss in Australia. Commodity prices are softish, but they're not plummeting. And the reality is our currency is at the level it was when Paul Keating made his Banana Republic speech in the mid-80s. And the only time it's been lower than this is in crisis environments, whether that be the start of...
61.37 cents today.
Yeah. So
crisis environments.
Well, it is. And it's not a crisis in terms of our economy. So I am worried that this is a reflection of pressure on the RBA to cut rates.
Yeah, dollar's down almost 10% over the past 6 months. Is this really a fact because the US is now not looking like they're really going to cut rates anymore, but the expectation is we'll be cutting here at some point this year?
Yeah, well, that's part of that dynamic, of course. And we actually we see this sell-off in US bonds, rising yields being persistent through the last 4 weeks, and in the last few days breaking up to a level that I think is very worrying. It signals higher rates into the future, at 4.7% on the US 10-year bond yield. And our bond yield, our 10-year bond yield, was above that in the US, and then it fell below it because of this idea that the RBA is going to keep ours lower or cut. And so that's sort of a real complicating factor for the RBA because the global outlook is looking a little better in terms of rates and less Fed rate cuts, and that makes it harder for them to cut, bottom line, because, as you said, the weak Aussie dollar is inflationary.
Yeah, do you think they're getting worried about how low the dollar is?
Look, they will worry if it's disorderly, that the market's not functioning. They don't tend to worry about levels. But I think at the moment for the RBA board and their policy setting issue is, it's inflationary. And we know that if demand is okay in the economy and the currency goes down, then the price will go up of imported goods, whether that be motor vehicles, whether that be other consumer goods. So I think that's the thing that's going to worry them. I think it's just another reason not to cut interest rates in February. And I don't think they will. I think the market is trying to cope with all this political pressure and all this sort of pre-election noise. And I think in the end, the RBA does not have an economic reason to cut. And in fact, if anything, it's actually a really dangerous policy.
Yeah, well, the first board meeting kicks off February 17 and they'll make their announcement on the 18th of Feb. We just had a chart showing CBA still expect to cut in Feb. Do you think we'll see a rate cut at all this year?
Look, we may later in the year. I mean, the way I'm seeing this economy is that it's actually getting better. The real problem we've had in the last few years is all this pressure on household incomes and then consumer going into their shell and consumption being soft. Well, we're getting signs that that's picking up. The November retail sales numbers last week were up 0.8. They're up 1.7% in the last 3 months, or to November. That's almost 7% annualised. Consumer sentiment's up. Employment growth is strong. So the things that were hurting our economy are now starting to improve. We know businesses are hanging in there and they're hiring and investing. So I just don't think the case is going to be made for a rate cut. And I think we still have this lingering concern with inflation, which is the thing that's doing the damage to our community and I think the political damage to our government.
Yeah, the lower dollar obviously putting upwards pressure on inflation. We've got the CPI indicator last week. We'll get the actual quarterly numbers at the end of this month. Do you think inflation is still on the way down or is it going to be pretty bumpy?
Well, I think the numbers we'll get are critical and because they're clean. These monthly numbers are not complete.
They jump around a lot.
And they jump around and we don't, even the best analysts in the market are struggling to work out what they mean. And we know that government subsidies and various things are making it hard to read and it's understating inflation. So the quarterly number in 2 weeks is absolutely critical. I think the number will actually be okay, but I don't think it changes the story that the disinflation or the falling inflation is very gradual. But more importantly, the RBA needs to be confident inflation's going to 2 to 3% and staying there before they can cut. And the developments of the last month, whether it's the bond market, retail sales, the stronger job vacancies numbers, all of them tell us that confidence isn't there. So while the market will probably interpret a soft CPI as a green light for a cut, I don't think it is. So it's going to be a very volatile 4 weeks ahead of that RBA meeting.
Now, you mentioned the government. There was an article in the AFR recently suggesting due to higher tax take, there could actually be a budget surplus this year. Do you think there's some truth to that?
Oh, well, there is. And I mean, it just reflects this strength in the economy. I mean, those who think the economy is weak are looking at certain things like GDP growth, which is constrained. We can only grow that so strong. But the fact is that the income tax revenues and other tax revenues from the government are very, very solid. And if we do start to see talk of a surplus come through, I mean, it just highlights that the policy mix is not right. We've got too much sort of strength in the economy for this level of rates. And a rate cut is madness in this context. And of course, the upside surprise on revenue for the government highlights another thing, is that it's bracket creep and income tax burden that's rising on consumers. It's what's hurting them as opposed to higher interest rates.
And iron ore price has been doing pretty well. And with the low dollar, that sort of encourages overseas customers almost to buy more of it as well. They get a better deal.
Exactly. And also it supercharges the Aussie dollar value because it's all US dollar priced. And of course, the government assumes iron ore is going back to, I think, $65, $70.
Or something,
yeah. So even if it just stays at 100, which is lower than where it's been when it's a good market, and the Aussie dollar is a lot lower than they forecast, it supercharges the revenue. So once again, it just highlights that there's still a lot of support for our economy, and a rate cut is not necessary, particularly given that inflation is still the main problem facing our community.
Warren Hogan, Chief Economist at EQ Economics. Thanks for coming on the show.
Thanks, Ed.